Every transaction in this company needs to land somewhere. The steel coil that arrives on Monday morning, the zinc coating applied on Tuesday, the finished sheet loaded onto a truck on Friday, the invoice is raised, the payment is received. Every single one of those movements, every cost, every dollar of revenue, every asset, every liability has to be somewhere in the system. That somewhere is the chart of accounts. And today I'm going to show you exactly how one is built. Welcome back, I'm Victoria, and this is episode 3 of Inside a Financial System Implementation. In episode 2, we talked about choosing the right system. Today, we get hands-on. I'm going to walk you through a real chart of accounts built for a roofing sheet manufacturing company, tab by tab, and this is the actual financial architecture that goes into an ERP before a single transaction is ever posted. One more thing, before we start, I'm a business analyst with a strong background in finance and accounting. What I'm showing you today is the implementation and the structural side of a COA, how it's designed, why it's designed the way it is, and what it means for your ERP. Before we look at a single account, I want to show you this tab first, because this is the skeleton and everything else hangs off of it. What we've done here is divide the entire chart into logical blocks using number ranges, and this is not arbitrary. The 1000 series is assets, the 2000 series is liability, the 3000 series is equity, the 4000 series is revenue, 5000 cost of goods sold, 6000 covers operating expenses, 7000 is for finance cost, 8000 is for taxation, and 9000 series is for clearing and control accounts. We're going to come back to those because they matter more than most people realize. You'll notice gaps between the ranges, and this is intentional. I'm leaving room to account for these later without breaking the structure, because one of the most common mistakes I see in first-time implementations is packing the numbers too closely together, too tight. 6 months after go live, the business might need a new account. And you know what happens? There is no space, so it gets wedged somewhere that doesn't quite make sense. And now your reports become messy, your ERP is fighting the structure you gave it. This tab is the rules of the road. Before anyone posts a single transaction, the system needs to know what every account is, how it behaves, and where it lives on the financial statement. Let me break down the columns that matter most. Account type. Every account in this COA is one of 6 types. We have the asset, we have the liability, we have the equity, we have the revenue, we have the expenses, and we have others. The ERP reads this to determine how the account behaves, whether it carries forward at year-end or it closes out, how it appears in reporting, and what postings are valid against it. Normal balance like debits or credits, this isn't just accounting terminology. It's a system control. The balance sheet accounts, which are the assets, the liabilities, the equity, these carry forward. They do not reset at year-end. They represent the financial position of the business at any point in time. The profit and loss accounts, which are the revenue and expenses, these close out. At year-end, the net results flow into the retained earnings in the balance sheet. Account 3130 in this COA, which is the current year profit and loss, is exactly where that landing happens. And then we have the tax codes. GST in, which is on the purchase side accounts, is input tax, that's claimable. GST out is on the sales accounts, that's output tax, which is remittable to the government. Zero rated tax is on export revenue. The GST only applies at 0%. What happens is that your ERP uses these codes to calculate and reconcile your tax obligations automatically. If you get them wrong at this stage, your tax reports will be wrong from day one. Okay, here it is. The Roofing Sheets Manufacturing Company General Ledger Master. I'm going to walk you through the sections that matter the most, and I'm going to flag those places where a manufacturing COA looks completely different from that of a service company or retail business. Because of those differences, they are not cosmetic. They determine whether your cost reporting is accurate, whether your margin analysis is trustworthy, and whether your leadership team is making decisions on real numbers. We start at the top: cash, receivables, prepayments, nothing unusual. But when you scroll down to the 1300s where we have the inventory, this is where a manufacturer looks completely different from any other business type. Look at how granular this gets. 1310 raw materials, steel coils, the hot and the cold rolled coils that arrive at the factory gate and they go straight to the production line. 1320, that's raw materials, coatings, chemicals, zinc, paint, primers, passivation, chemicals, every gram that goes into galvanizing and color coating a roofing sheet. 1350, that's work in process. This is the steel coil that's mid-production right now. It's on the line, it's being rolled, it's being coated, it's being cut. It's not a finished product, so not a sale yet. And it needs its own account. And then we have the finished goods, broken out by product line. So we have the 1360 galvanized sheets, 1370 color coated, 1380 corrugated, 1390 accessories, and others. And you may ask, why does this level of granularity matter? This is because your ERP's inventory module tracks each of these separately. If you collapse all your inventory into one single account, you lose visibility into exactly what's driving your working capital. And for a manufacturer, inventory is almost one of the largest line items on the balance sheet. You need to see it clearly and not just as a single number. Over in non-current assets, notice how each major piece of plant has its own account, and it's sitting directly beneath its own accumulated depreciation contra account. Roll forming lines 1530 and 1531, galvanizing plant 1540 and 1541, painting line 1550 and 1551. Each production line is tracked separately so your operations teams can see the written down value of each line, not just one lump sum. Plant and equipment numbers tell them nothing. The revenue is broken out by product line. What this means is that reporting is broken out by product line and it's built into the structure from day one. That's galvanized sheets, color-coated, corrugated, custom profiles, scrap, steel revenue. Export sales at 4200 is sitting separately with the zero-rated tax code. And then look at 4300 and 4310. Sales returns and allowances, sales discounts. These sit inside the revenue section, but they carry a debit normal balance. They're contra revenue accounts. They reduce gross revenue to get you to the net revenue on the profit and loss. Your ERP needs these flagged correctly. If they're miscategorized as expenses, your gross margin calculation is wrong every single month, and the leadership team is looking at a number that isn't real. This is the section that surprises most people who haven't worked inside a manufacturing implementation before. The cost of goods sold for a manufacturer isn't just cost of goods sold. Look at what's here. For this example, direct materials could be steel coils consumed, zinc coating, packaging. These are raw materials that became the product. Direct labor is a production wage, overtime, casuals, the people on the floor who are making the roofing sheets. And then there's a full block of manufacturing overhead like electricity, gas and fuel, water maintenance and repairs, consumables and lubricants, even depreciation on plant, factory rent, control safety, and PPE. Here's a question I get asked most often at this point. Why is electricity in cost of goods sold and not operating expenses? Because for a roll forming and galvanizing operation, power consumption on the production floor is a direct cost of making the product. It's not an overhead of running the business, it's an overhead of running the production line. Your ERP's cost accounting module maps those overhead accounts to production cost centers. If you get it wrong here and your product costing is off, your margins are off, and every pricing decision downstream is made on inaccurate information. Don't skip past the 9000 series. I know it looks like a footnote, but it isn't. Account 9130 is your suspense account. Transactions that don't have a clear home yet, they land here temporarily. The rule is it clears within the period. If it's not clearing, something is wrong. This is your account's way of sending you an early warning signal. And account 9140, which is your opening balance equity, this one exists specifically for go live. When you migrate your opening balances from the old system, the debits and the credits rarely match perfectly on day one. This account absorbs that difference while the team reconciles it. It is a temporary account and it should reach zero before your first period close. If it doesn't, please stop and investigate before you go any further. Everything we've just walked through, 4 tabs of deliberate financial architecture, it gets distilled into this. The ERP Import Template, this is the actual file that goes into the system, the one that your administrator uses to load the entire chart of accounts in one action. Let me take you through the columns that actually matter. The GL account number, that is your account number exactly as designed. The account type, that's your assets, your liability, your revenue, your expense, headers, and others. The ERP reads and determines how the account behaves in the system using this. The account name is the display name that appears on every report, every journal entry, and every drop-down menu in the system. Get the naming consistent, correct at the beginning. Renaming accounts mid-implementation can be painful. Renaming after go live is a project in itself, to be honest. Categories and subcategories, these drive your financial reports and your financial groupings. In most ERP systems, these map directly to the report structure. And then the 2 columns most people overlook entirely. That is the is active and the is posting. Is active is the account live in the system. You can deactivate accounts without deleting them, and they're useful for accounts that you're not ready to use yet or that have been phased out. Is posting accounts is a very critical one. See how the header accounts, 1000, 1100, 2000, have posting accounts set to no. That means nobody, no user, no automated process can post transactions directly into the header account. Transactions only hit the leaf accounts. Those are the real posting accounts. That's a built-in control and it's configured right here in the import file before the system ever goes live. This is why design work matters. These are not just spreadsheets decisions. They become a system control that governs how every transaction in your system is recorded from day one. 4 tabs, 1 cohesive structure, built specifically for a company that takes raw steel and turns it into roofing sheets. The chart of accounts doesn't make it onto the board presentation. Nobody puts it in the project announcement, but it is the foundation that every single financial transaction in your new system will sit on. Get it right here and your reporting, your tax, product costing, and period end close all become manageable. However, if you get it wrong, you will be doing workarounds from day one. Next episode, we're going to talk about the implementation itself. We've designed the foundation. Now we'll talk about what happens next when the project actually goes live. The governance, the team dynamics, and the things that even surprise experienced leaders once the work is actually underway. And of course, there's that moment when the numbers don't match. We're going to talk about what that actually means. I'm Victoria Hanshaw. If this was useful, please share it with someone in your organization that is about to start the process. Subscribe so you don't miss episode 4, and I'll see you there.